Hello and welcome to Moss Adams Virtual 2024 Building Opportunity Conference. We are pleased that you all have joined us today, and before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
This is the first of 4 sessions in our 2024 Building Opportunity Conference. Today's topic is Stay Focused on the Economy Amid Political Noise. And now I'd like to introduce today's moderator, Chad Averill. Chad is the leader of the National Construction, Real Estate, Hospitality, Restaurant, and Professional Services practice. He has been in public accounting for over 20 years and provides accounting and business advisory services to private and publicly held companies. Chad, I will hand it over to you.
Thank you, Cole. I want to thank everyone again for joining us today. Each year, we host the Building Opportunity Conference to bring insights to our audience around emerging trends impacting the various industries within the built world. Over the course of this year's series, you will hear from industry leaders, economic experts, and legislative specialists who will guide us through the challenges and opportunities ahead. We hope you find valuable insights and takeaways to help shape your strategies for the future. Now I'd like to introduce you to our presenters. Steve Scranton is the Chief Economist for Washington Trust Bank. He has over 40 years of investment and economic experience, is a well-known author and speaker on economic conditions. Steve, the floor is yours.
Thank you, Chad. Good morning, everybody. Thank you for attending, and thank you to Moss Adams for giving me the opportunity to give you my insights and thoughts about what's going on with the economy. I think it is nice to be able to say that for the last 2 years, the consistent question I've always gotten is, when is the Fed going to start lowering interest rates? Now the question has shifted to, how much is the Fed going to be lowering interest rates and how fast? And so I think that's really where I wanted to start off with today's discussion. I would remind everybody that, as you heard from the video, that if you have questions, you can submit them through the Q&A and you don't have to wait till the end. As we take the polling questions, if there were the polling surveys, if there were questions in the Q&A, I'll try and answer a couple of those while you respond to the polls. So please feel free to do that anytime. But let's kick it off, get you engaged in this presentation by starting right off with a poll question, which is, what do you think will be the average inflation rate in 2025? Do you think it'll be between 0 to 1%, 1 to 2%, 2 to 3, or more than 3%? Go ahead and wait a few seconds to let you make your responses, and then we'll see what the results tell us you think. I think that is the big question that people are trying to resolve, because that is one of the major factors that the Fed's going to be considering is really two factors: what's going on with inflation, what's going on with the labor markets. And inflation is the one that they focused on for the last 2 years. Now they've moved more towards a balanced approach of looking at both. So I'll wait and see when the results are. And when it pops
just as
up,
a quick reminder, the polling questions are located on the slides, so make sure you have your slide window open, and we'll give it about 5 more seconds to respond. To respond, please click the button next to your answer you choose and make sure you hit submit so it tracks your CPE. Give it 3 more seconds here. And the question is now, oops, sorry.
my fault.
Go back to that. Oh, no worries. There you go. Back to you, Steve.
So you can see that most of the participants, over 50%, believe that inflation will be somewhere between 2 to 3%. The Fed's goal is getting it down to 2%. And what I want to do for you now is first to remind you that the Fed's mandate by their charter, they have a dual mandate, which is different than most of the other developed country central banks, which is strictly to keep inflation stable. The Fed's mandate is stable inflation plus full employment. And I think that's really why I want to first start with seeing what's going on with inflation and then employment, to give you my perspective then on what I think Fed will do with rates, then walk through what's happening with the economy, and then some risks we should consider. So what I want you to think about as I show you the next graph is, imagine that you are, you've had your boss come to you at the beginning of 2024 and say, look, our expense growth has just been out of control for the last couple of years for a variety of reasons, but we need to get expense growth back into the 2% range. And I'd be happy if you guys could bring it in 2 to 2.25%. So that was your marching orders at the beginning of the year. Comes August, and now you just got the report from your finance department that you've got to take to your boss. And this is what you see, which is what the Federal Reserve is saying, is that through August, year-to-date inflation, they look at 2 different inflation indexes, which would be similar to looking at cost report. The core PCE is at 1.9% through August, and the core consumer price index is at 2.1%. I would leave it to you yourself to say, would you be too thrilled going to your boss, showing him those results when you're 8 months into the year and still 4 months left to go? What Chairman Powell has said is that they are encouraged by the path that it's going, and they believe that even though we're not there yet, that we will be in that range by the end of the year. I just simply say, if we're at 1.9% and 2.1%, average that together, say that we're currently at 2%, that means you've got to have, if inflation increased by 0.1% each month for the rest of the year, you'd be at 2.4%. I don't know, but apparently the Fed is indicating they will live at that number as long as they think that it'll continue to come down into 2025 as well. So that's your perspective on where we stand right now. I would have said, just isolated on its own, inflation is not at target, so there wouldn't be a need to cut interest rates. But again, their mandate is a dual mandate. And what I try and show people is the problem with the inflation, why it continues to be sticky and not moving down as much as people want it to, is most of the inflation lies on the service side of the economy, not the goods side. So looking at this graph, what I'm showing you is where we've seen the biggest year-over-year increase was in the transportation sector. That means airfare, train, bus, but it also means, which is a big number right now, auto insurance. We've had for 2 months in a row, auto insurance up over 16%. And that hits home in the pocketbooks of most average consumers. But you can go down the line, daycare, up 6.2%, shelter, which is essentially rent, up over 5%. You can march right down the line. The only one that is above 2% that isn't services is electricity. But all the rest, we see restaurants, food away from home, essentially, medical services, all of those are still above 2% inflation. So we don't have inflation on the goods producing side of the economy. We can see that those are all below 2%. And some of them, like gasoline and used cars, are actually negative year over year. But the problem is that service sector makes up a bigger portion of the economy than the goods producing side. And that's why we continue to see inflation slowly coming down. I gave you, looking at that previous slide, I gave you the year-to-date numbers. The year-over-year numbers, which is what gets reported by the media, is even not as pretty, because right now those core numbers are at 2.7%. So that's even further away from the 2%. So I just think that we're going to have to continue to watch the inflation story. When we look at the employment side, what I say is the best way to measure full employment is look at the number of job openings versus the number of unemployed. You know, the perfect scenario that the Federal Reserve would say is a 1-to-1 ratio, because you're always going to have a disconnect between open jobs and unemployed with skill sets and stuff like that. But the main thing I'd point out is a couple things to you that you can see by looking at this graph. Since the Fed started tracking the jobs opening data, which is back to 2005, what we see is that we never had a situation until 2018 where businesses didn't have more unemployed people than job openings, which means that businesses had a pool to be able to select from, try and find the best qualified candidates. We saw that steadily decreasing as the expansion occurred after the financial crisis. And by 2018, we had job openings and unemployed match each other, and then went the other way, where there was more job openings than unemployed people. And that I can tell you just from personal experience of visiting businesses during that time period, hearing especially from the construction and manufacturing industry, they were experiencing labor issues then of finding enough qualified help. Pandemic crisis hit, and of course, that messed everything up temporarily. But then what we saw was when we reopened the economy, because of all the fiscal stimulus, a lot of people not incented to go back to work yet, we got to the situation where there were more than 2 job openings for every unemployed person. And from the Federal Reserve's perspective, that was way too tight of a labor market. That meant, their concern was that was going to create a wage price spiral that we'd already seen some big increases might continue. That's when they started raising rates. And now we've seen that job openings have steadily come down. The unemployed has risen some. So we actually have got, as of August 31st, only a 400,000 differential between job openings and unemployed people. So I think that's where the Fed would say mission accomplished. We've got basically a stable or a balanced labor market. Individual businesses may or may not agree with that, but that's what they're looking at. The other thing that they would monitor is saying if things are really starting to weaken in the labor market, then what we should see is the number of unemployed people starting to rise. And yet when we look at the initial jobless claims, which is once you get laid off, you initially file for unemployment benefits, we should see that steadily rising if the labor market really was weakening. What we see instead is really since the Fed started raising interest rates in 2022, initial jobless claims have really just kind of traded in a range with a peak around 250,000, the bottom down around 200,000, and then just volatility in between. And since I had to submit the slides, we got more data. Last week, we saw initial jobless claims fall down to 218,000, which puts us even more in the middle of that range. So I would say right now, we're still seeing a case of businesses being very reluctant to lay off people until they really feel that the economy is going to start moving towards a recession. We see similar with the continuing jobless claims. That's people, once you've been laid off, you still can't find work, you continue to apply for those unemployment benefits. Been pretty stable after the big drop off from the pandemic crisis. Another story there that we're not seeing any real rising trend there. So let me pause there once again, because I want to get your feedback with our second poll question, which is, what is your experience with filling job openings? Have they been easy to fill? Is it still a challenge, but getting easier? Not hard to fill? Still a challenge, getting harder, or very hard to fill? So once again, we'll give you some time to answer those questions. And I'm trying to see, we do have some questions coming in. So let me see if I can scroll through and see if I can answer one of these fairly quickly. One of the questions is, will legal immigration help with inflation in the service sector? What I tell you is, especially over the last year, we have seen a big surge in legal immigration. If we set aside the noise of politics and what's being claimed back and forth there, the bottom line is we have seen a big uptick in legal immigration. And I do think it's at least stabilize for some sectors of not having to continue to make big salary increases to retain their employees. I think from just a general standpoint, I'd tell you, the more labor force that's available, the less inflationary pressures, because businesses will have more options. And historically, the U.S. has always been able to fill their labor gaps with legal immigration. And so I would say, once again, that would be a yes, that it should help that process. So let's see if we have our poll results now.
And then real quick, Steve, as a quick reminder, you will have to answer at least 3 of the 4 polling questions today to receive CPE for today's webcast.
Perfect. So what we're seeing is over 50% of you are saying it's still a challenge, but it's getting easier. I would reflect that's what I'm hearing when I travel through our 3 states of Washington, Oregon, and Idaho and talk with our businesses throughout those areas. Similar story. They're saying, they're starting to see things getting a little easier, but it's hardly anything to say, hey, it's no problem. So I think you reflect what I would also reflect that I have seen. So let's turn then, I guess what I tell you, my views on what's going on with the interest rates, what's the future direction. I think that history has shown pretty clearly that once the Fed changes course on policy, they will continue with that course for some period of time. There may be pauses in there. Chairman Powell was very clear to say, just because they cut rates by 0.5% this time doesn't mean they're going to cut 0.5% every time. And it doesn't mean that they're going to cut rates every time they meet, which is 8 times a year. So I think that what I would tell you is it's really going to hinge, if I'm trying to read the minds of the Federal Reserve, I'd say 2 reasons why I think they went by a 0.5% interest rate cut rather than 0.25%. One is I think they would like to kind of provide that big hit to begin with, so then they can hopefully stay out of the way during the election period and maybe not have to do anything more for the rest of the year. But I think the other is, I think the Federal Reserve, and I'm just trying to give an educated guess, I think they've been spooked by the continued downward revisions of the jobs reports we get every month. And they're worried that maybe the labor market is actually weaker than it looks. And I think their worry is that, look, if businesses are still holding back on laying people off, if they start to see real signs of the economy weakening, the floodgates could open and there'd be a huge amount of layoffs happening then. So the Fed's trying to be proactive here. They're trying to provide enough fuel to keep the economy going without being inflationary. And I truly do believe, and they've been doing what they say, they're going to be data dependent, and depending on what they see for the data over the rest of the year will determine whether they lower interest rates further for the rest of the year or whether they hold off. But the real bottom line is they're saying they want to bring the Fed funds or the overnight borrowing rate back to the neutral level, because they believe this level that they've had it at has been restrictive. And if they continue to keep it here, they will start slowing the economy more and more on a cumulative effect. The problem is nobody knows where the neutral rate is until you've seen it for a while and say, okay, now we seem to be pretty stable. But the bottom line is I do think for borrowers who have short-term borrowing tied to variable rates, usually it's tied to a short-term benchmark, you are going to see your borrowing costs coming down. So that means those businesses who have lines of credits or operating lines, they should see their borrowing costs coming down. Term financing, I'm not as sure that you're going to see that. That's really going to hinge on what inflation does. We didn't see really any change in the 10-year Treasury after the Fed lowered rates. And I think that would be logical, because that's not something that Fed controls directly. But the general direction of interest rates, I think, is now on a downward path. It's just a matter of how deep and how fast. So let's look at the economy now and see just where do we stand with the economy. Many of you have heard me speak before. I've always said that I view the economy through the lens of jobs, because jobs are what create income. Income is that fuel that consumers use to spend, and consumer spending is still almost 2/3 of U.S. economic growth. So the picture that I would tell you I see here is that jobs growth has definitely slowed, but it's not falling off a cliff. The forecast that I've seen so far, we'll get our next jobs report coming up this Friday. Most of the forecasts have been for an increase. We had 142,000 jobs created last month. Forecast for around 160 to 170,000 for September, which will be reported this coming Friday. We did get ADP's version of non-farm payrolls today. they definitely saw an increase in jobs. They went from 104,000 up to 143,000 jobs created in September. So that's a slower pace than what we had before, but it isn't a pace that I would say, hey, the economy is really getting ready to tip over and fall into recession here in the near future. And that was Chairman Powell's message as well. He said they did not cut interest rates because they're concerned the economy is on the verge of a recession. They feel the economy is in good shape, that inflation is going the right way. So now is the time to be proactive and start the process before the problem actually occurs. When we look at spending, this is a graph that is now out of date. It was current when I sent it in, but we got an update to personal income and personal spending last Friday. And the Bureau of Economic Analysis did a major revision to the income side. They actually showed, this graph would show you, what I'm showing is year over year growth. It showed that personal spending was rising at a 2.7% annual rate, and personal income was only rising at 1.1%. And that's what had a lot of economists, including me, saying that can't go on forever. You can't keep spending faster than your income. But now the Bureau of Economic Analysis came through after doing more extensive, which is a standard thing they do every year, but they made a pretty substantial revision, because now they say that personal spending rose at 2.9% instead of 2.7%, but that personal income, instead of rising 1.1%, rose 3.1%. So now we've suddenly flipped this graph, that spending, the growth of spending is less than the growth of income. And that's a much better picture for the economy going forward. So right now, it's a positive look. I think the big question the Federal Reserve's worried about is with these strikes that are now going on. We already saw with the UPS and with the Teamsters Union for the auto industry, some pretty big salary increases there. Now we've got Boeing and we've got the longshoremen demanding significant increases as well. I think that would cause the Fed some concern, saying if we get big salary increases, businesses will most likely try and pass that through to the price of their goods and services, and then we could have an ongoing inflation problem that we just can't get it down as much as we thought. But I think that is pure speculation right now. We're going to have to wait and see how long these strikes are and how big the settlements are. Breaking it down for you, and again, these numbers are slightly off now, so let me give you the updated number. What we see is that spending on services is now growing at a 3% year-over-year rate, spending on goods at a 2.7%, and total spending at 2.9%. So it's still the case that we're spending more on services than on goods, and that's where the sticky part of inflation is. So I think that's really where we need to see as a slowdown in the spending on the services side if we want to see prices stabilize and inflation come down. Bottom line, though, when we look at the economy, this is year over year growth. This is different than what they report on a quarterly basis. Each quarter, the government reports the quarterly GDP growth annualized. So what they're doing is taking the quarterly results and then assuming that pace continued for the whole year and say, here's the annualized. This is actual, what happened year over year from last year to this year. And what we have seen is that we are right in the range, if you just look at the graph, about the same place of where we were for that full 10 years of the recovery after the financial crisis. We're running 3% year over year in the second quarter, and the forecast so far that I've seen from the various sources, the Atlanta Fed's GDP forecast is for 3%. The New York Fed's forecast, they have another model for real time, is running at, excuse me, I just lost I clicked something wrong here. I need some help getting the screen back up if somebody could help me with that. I've got a full screen for Q&A. Yeah, I don't have the slide showing anymore. I clicked on something by mistake and got the Q&A as a full screen. How do I change that?
You want to try sliding the, do you see that slider little thing in between the presentation slides and the media player?
I apologize, everybody. No, I don't have, let me see if I can, there we go. I can see it again. Sorry.
Okay, great.
Anyway, you can see that we've got an economy that's growing at 3%. And as I said, the forecasts from the ones who are the two Federal Reserve offices that run a real-time type of forecast, both running right about 3%. And so I think I would tell people right now, economy is still on solid footing now. The question is, will it continue heading into next year, or what is going to happen that way? And so let me just get your opinion then. When we do the poll, it's where do you see the economic growth by the end of 2025? And getting lots of questions. Appreciate everybody's questions. Let me see if I can scroll through here and find one that I can answer fairly quickly for you. Okay, we've answered the legal immigration. Do I think that the president should intervene with the port strike? If this continues, won't this increase inflation? It comes down to, again, whether we want government intervention in different sources that way. President Biden has been very clear. He said this is a negotiation process, and that even though Taft-Hartley allows him to do that, he believes that you should let them negotiate and reach the settlements that the markets would determine as fair. I think it really just comes down to what is in the agreement. Is it more the salary increase they're looking for, or is it the other major negotiating point, which is they want an end to or a severe reduction in the amount of automation occurring? So if they're shooting for job security over wage growth, I think that's where it's going to come down to. But the bottom line is, depending on the size of that increase, it could well be, that would mean it's more expenses for the shipping industries. And if they try and pass that through to the cost of their services, then that's going to ultimately be inflationary. The wage increase itself is not inflationary. The passing it through is inflationary. So let's see where we stand here. Right now, it looks like what we've got is 46% of you think it'll be 1% to 2% at a steady pace. And the next highest is thinking that it'll be 0 to 1% slowing. I'll tell you that my view falls in similarly. I do think the economy slows, that it won't maintain a 3% rate. But I think that potentially we're back into the similar type of growth levels that we saw after the financial crisis, where we're in this 2%, and whether that's acceptable for people or helpful remains to be seen. But I would agree that I think we'll see slowing. I can tell you the bank's overall forecast from its interest rate or economic committee that we have thinks that it slows steadily through 2025 down to almost just slightly less than 1% by the end of the year, and then starts to pick up strength again. So we currently don't have a recession in our forecast over the next 2 years. So what are the risks then we need to monitor? If you're saying, well, gee, Steve, you're saying looks like the economy is in good shape, I don't need to worry about it then. I always say that good managers are always good risk managers of thinking, well, what could go wrong, or what am I missing? So what I continue to worry about is the consumer themselves. I think that we've got a bifurcated economy from that perspective, that the macro data looks very solid, but it's getting overshadowed by the upper 50% of wage earners, and we're not picking up the distress of the lower 50%. And I've just given the analogy before is that I think that lower 50% is kind of the foundation for the economy. And as we all know, if a foundation starts to crack or crumble, then the whole house or the whole economy is going to have a problem. And I think there are clearly still signs of stress for the lower wage earners that aren't getting those types of contracts passed for them. I think the first place we need to look for both businesses and the consumer, because so much of this spending has been based on borrowing, with debt being growing as we go along there. So in order to enable to continue to have the ability to borrow for a sound business project or for other reasons for consumers, you got to have liquidity in the system available for that borrowing. And it always starts first with the financial services industry, because that's their businesses. They take in deposits and then they turn around and lend it out for loan activity. And what we see is that really once the Federal Reserve started raising rates, we saw the deposits starting to decline at banks. We did have that, big drop you can see in 2023 when we had the Silicon Valley, that whole banking thing. But the real story going on here is that with the advent of technology and the access for both businesses and consumers to be able to see where interest rates and everything else are in real time, when the gap started to grow between what the financial institutions were willing to pay for deposits versus what you could get by taking your money to a money market mutual fund and still have relatively quick access to your funds, then money started to shift. And the problem for the financial institutions is, they have loans on the other side. A lot of those loans made during the 10 years of the economic growth before the financial crisis in the 3 to 4% range. And now the deposit rates, if they were raising it to current market rates, they would have had a negative spread there. So we saw an outflow out of the financial service industry into the money market mutual fund industry. And money market mutual funds cannot make loans. The only loans they make is to the U.S. government when they buy their U.S. Treasury securities for the fund itself. So you saw the big drop in deposits. Now we've been slowly seeing that ratcheting up gradually. I would anticipate as the financial market, the money market rates come down with the Federal Reserve lowering rates, that differential will get smaller and smaller. And I wouldn't be at all surprised to see that money continuing to come back to the banking system as a whole. So we need to monitor this, because if we saw it go the other way and a continued outflow, that just means every dollar of deposits that leave a financial institution is a dollar less that they can lend to a business or an individual. When we look at the other one, which is the actual money supply, M1, I look at M1 because it's all the liquid things. It's checking accounts, all of those types of things. What it does not include, though, are money market mutual funds. And so you can see the same pattern here, as that money flowed out of your traditional places like a checking account, a savings account, something like that, flowed to the money market mutual funds. And now that has at least stabilized, and we'll have to watch and see where things go from there. The Fed's view, by raising rates, they want to drain liquidity, because less money available means less activity, less pressure on prices as a result, that type of thing. So that's their historic way of trying to slow economic growth, is just make projects unfeasible, things like that, to slow the economy down. And of course, their magic trick they're trying to play is, do we know when to reverse course and not actually create a snowball effect that we roll into a recession? When we look at the last one, which is the Federal Reserve itself, we saw during the financial crisis, or after the financial crisis and after the pandemic crisis, but really for the last almost 15 years, the Federal Reserve was suppressing interest rates by printing money, buying U.S. government securities to drive the yields down on those, which would then push down yields for all the other types of products that are priced against that, loans or other things. So what the Federal Reserve announced when they started raising rates, that they were also going to let their balance sheet roll off, that when treasuries matured, they weren't going to purchase new ones. That means that somebody else would have to buy those instead. And since a business, an individual, those type of people can't print money like the Fed, that would mean that every dollar that they use to invest in U.S. Treasury securities, dollar not used for buying goods or services, and that would be a way to slow the economy again. You can see that it's run off almost by $2 trillion so far. And even though the Fed is lowering rates, they are still doing what they call quantitative tightening, letting their balance sheet roll off. And they have not indicated, Chairman Powell indicated he thought by next year that program could probably come to an end, but it's definitely not coming to an end at this point in time. So there is still liquidity being drained by the Fed and not renewing their purchases of securities and leaving it to somebody else to buy that debt instead. So then when we look at how is that impacted with liquidity where it was, with interest rates, where's the consumer stress? And what I worry about is this one, what I'm looking at is that we saw, especially after the pandemic crisis, a lot of the average workers really benefited by having their hours increased and being able to live off of a higher, that's essentially a raise without actually giving a raise. It's just more hours. The problem is, if you got used to that and you started to change your spending habits based on that level of hours worked and that level of income, now what you've seen is essentially the equivalent of pay cuts, because we've gone from 35 hours a week at the peak down to 34.3 hours. And so, that on a relative basis, when you say, well, that's not very much, it's only 0.7%. Well, when you do that over a full year, that's over 36 hours. That's essentially saying that since the average work week is 34.3, that difference in the pay of what you got used to versus what you now have is essentially working a day for free because of that reduction. So I think may not impact a salaried worker, may not impact the upper income people, but the hourly workers, they're still having to pay the same type of higher expenses that everybody else, and yet they have not seen their hours worked increasing. And when you look at the graph overall, we are actually on the lower end of the range of where we were after the financial crisis. So it's clearly a case there that even though we may say average hourly earnings have gone up, average weekly earnings haven't gone up nearly as much. Average hourly earnings increased 3.8% year over year as of August. Average weekly earnings only increased 3.5%. So I think that is something we'll have to watch. If companies still say, I'm afraid to lay people off, so instead of laying one person off, I'm just going to cut everybody's salaries by, a certain amount to achieve the same cost savings. Well, that impacts all of those workers rather than just one person being laid off. The other area that I worry about is this level of people that are having to work multiple jobs. I would simply say, yes, there are a handful, small component of people that are saying, especially with remote work, I can work one job and do another job on the side. But I think the majority of these people we see, they have a full-time job and now they have a part-time job because they just have to cover their bills. When you have daycare costs still going up 6%, car insurance, those types of things, the average worker is really, I believe, under stress as a result of that. So then what I look at is saying, well, what do we look like for delinquencies and defaults? Because that's where it would show up the fastest, is saying now there really is a problem developing. What I would simply say, if you look at that, this graph shows you the magenta colored line is credit card delinquencies, and then the green line are business loan delinquencies. You can see very clearly we're seeing very little delinquencies from the business side. It's on the consumer side. And you'd say, well, yeah, but that's not very high compared to looking at the graph where we've been before. And I say, absolutely, but it's still a change in the trend. We've very clearly got the trend rising now. If you dig beneath the surface, you would see that the subprime borrower, the one with a credit score below 450, they are actually in double-digit delinquency levels now, even though the overall is only around 5% or so. So I think that is something I just continue to monitor and say we need to pay attention to. Similar to charge-offs, it's the same basic pattern. It's all on the consumer side. It's more on the credit card side than other types of consumer loans. The trend has changed, and now we need to watch and see what happens with that trend, if it continues to worsen or if it levels off, and only time is going to give us the answer to that. So those are some of the risks that I'm saying we need to pay attention to and think about. The other risk that we have, and I've just used an example of some of the states throughout the West, really, where either we have offices, Moss Adams has offices, to give you some perspective. But what I've always called the hidden inflation, which are home prices. As you can see here, looking at the 5 states that I've shown you there, all of them have home prices above the U.S. average. And yet, not all of them have wages above the U.S. average. When I look at the next section, which is showing you the percentage increase, you can see once again that we've got a case where it's very challenging for people to say that we're worse than we are for the U.S. if I'm trying to buy a house. And I think that what this is telling you here is the mortgage payment as a percent of wages. It's just my simple calculation for affordability, which is saying if I take the average home price in the state and I take the average monthly salary in the state, calculate the mortgage payment on that average home price and say, what is that mortgage payment? And then how much of that mortgage payment is consumed from your income? What we would want to see normally in the lending world, if you want to qualify on one income, you need to be in the 28 to 30%, maybe 35% range. What we see here is that none of the states, including the U.S., are there. The U.S. is the best at 40%. Everybody else is 50% or higher, which means now you have to have 2 paychecks to buy that house, which you say, well, that's fine. We're both working. We're in great shape. We're going to look for a house to buy. The problem is, if anything ever happens to one of those incomes, now you've just put your shelter at risk, where you're at risk of either losing your house or making dramatic cutbacks in spending in other areas. So one of the things I've said over and over to states, especially, looking at the states that I've got here, is you need to understand that over time, if you suddenly are viewed as unaffordable, that your rent is unaffordable, your home prices are unaffordable, then there's other options. There are still states in the U.S., primarily in the Midwest, that are far cheaper. Right now, we haven't seen that type of shift, but I'm just saying any state that becomes overconfident, says it'll never be an issue, could find themselves suddenly having an outmigration. We've already seen that from the western states of Washington, Oregon, and California, moving inward to Idaho, Montana, places like that. Well, as those states become unaffordable, now you can see potentially further moves from there. And for those of you out of Idaho, there's a new phrase that I had somebody quote to me, which I just thought, as you want to make fun of your fellow states, that all of this migration from California, Oregon, and Washington, what they now say in Idaho is the cows are moving to Idaho, California, Oregon, Washington. So if you want to give a bad time to your Washington, Oregon neighbors or your California neighbors, there's a new phrase that you can throw their way. So let's take a look now as we look at the economy, look at the challenges for the economy. What are you for your business? What is the business obstacle to growth for your business? Is it difficulty filling open positions? Is it inflation? Is it taxes, poor sales? Or is it the bureaucracy of red tapes, regulations, and things like that? And let me just see. So one of the questions is, what have the mortgage payment as a percent of wages been over the past 10 to 20 years? It has been one where it's continued to increase. If I went back 20 years, most of your states would be affordable. But as we've seen home prices steadily rising, where I would say this problem is really accelerated is once the Federal Reserve, it was after the financial crisis, when the Federal Reserve suppressed interest rates. And then we had 3% or lower mortgage rates. So we stimulated demand for housing, especially for the millennial generation, but we didn't stimulate new supply. In fact, if anything, you're still facing the challenges, regulations, permitting, cost of land, and just cost of labor and raw materials. So I think the problem has really been over the last, let's say 15, really since 2010 forward is when it has rapidly accelerated. And it's been this cascade effect. It started on the coast of Washington, Oregon, and Idaho. Now we've seen that happening, even moving east, within the state. I can say for especially Oregon and Washington, where we have offices, it's your Spokanes, it's your Bend, Oregons that are now suddenly seeing their home prices accelerating. And now same with Idaho. So started, let's say 15 years ago, really accelerated the last 5 years or so. So let's see. That's a pretty almost an even mix there, that inflation is still the number one challenge for most businesses, followed by difficulty filling open positions and then poor sales. I would tell you that all of you reflect what the National Federation of Independent Business respondents say. It's almost exactly, percentages may be different, but those are the top three issues that they show as well for small businesses. So not to say that it's comforting to know that you're in the same camp with others, but it is something that's consistent with what we're seeing. So what I want to give you is my closing thoughts of what's going on here. And first, I would say, as I said, ignore the noise of politics. We got to understand that, and I just give you the example. During the Trump presidency, during his term, he was very anti-tech, and yet tech was the best performing sector. Biden was anti-energy, especially fossil fuel, and yet energy has been one of the best performing sectors. And I simply say businesses are in the business of making money, and they will always look for those opportunities. We see, especially like the energy sector, when we shifted our focus to green energy, well, then the fossil fuel, controlled supply and demand then, and yet we discovered we still needed that fossil fuel, and yet nobody's willing to drill new wells because they're saying, no way, that's not the focus of the administration anymore. I think the other thing that I would say is that, both Democrats and Republicans are focused on raising taxes. It's just what form of taxes. For the Democrats, it's what I call the wealth transfer, taxing the wealthy, taxing the corporations. For the Republicans, it's tariffs. No matter what the noise of politics may claim, tariffs are a tax. It's paid by the business, U.S. business, who goes to the dock to pick up their goods. they pay the tariff at that point in time. So both are looking for taxes to increase revenue. And I would also tell you that during both presidencies, just using the Trump presidency and the Biden administration, neither of them have shown discipline there. We saw during Trump's term, from his start to the end, the national debt rose by $9 billion. And then when we look at Biden, the national debt has risen by almost $8 billion. I would say that's pretty equal of spending and not paying for and with the revenues. So that's where I just say it's not going to be the president. The president doesn't run the country. It truly is Congress needing to pass those policies. And what I would say, in my view, as well as what I've seen from others, is we no longer have a two-party system. We actually have a four-party system because we have the extreme left, we have the centrist left, we have the extreme right, we have the centrist right. And as we saw both during Trump's term and during Biden's term, even if there is one of the arms of the House, whether the Congress or the House, the Senate or the House is completely Republican or completely Democrat, that's where we discovered that it's not, because you've got this fracture within the party itself. And the bottom line for maybe businesses is that it means there's not been any major change in legislation that would negatively impact the business. And that could well be the case of what we see going forward, because even though there's lots of promises being made during this election, what actually happens will be determined once we see what the composition is overall. And that's why I just say, ignore the noise of politics, stay focused on your business. What I say is keep in perspective, the recessions are a natural part of the business cycle. They always occur. Strong companies survive it. They actually flourish from it. The weaker companies are the ones that get washed out, but it gives you a stronger foundation for future growth, if a recession does occur. And I think what I've told people over and over again, they say, well, what should we do? Well, I'd say, for one, if you listened to me last year when I talked with you, and those who've listened to me for the past several years, my mantra has been develop an economic disaster recovery plan. Really, all I'm saying there is, while times are good, prepare for the bad, have a game plan ready. When you start to see that happening with your business, then you can react objectively and not emotionally to what's going on. Make sure you've got those liquidity sources so that you're not going to be caught off guard like a lot of businesses did with the financial crisis. Make sure you have a solid relationship with your financial institution, whoever it is. You don't want to be viewed as a transaction customer who's only shopping rates. You want to have a relationship so that when something happens, like the financial crisis, like the pandemic crisis, you weren't in the back of the line trying to get the PPP loans or something like that because you had a relationship with your bank. And I think the same side, I just say, make sure you're reaching out to your customers and your vendors as well to make sure they've got a game plan, because the last thing you want to do is say, I'm ready, and then discover that your supply chain got disrupted because your vendor or some part of that wasn't ready. So that's really the generic advice, because your own advice really is specific to your business, but that's what I would tell you overall. And I would just simply say, ignore the noise of politics, pay attention to what's going on with your business. If you see that things are still strong, keep doing what you're doing, and you'll start to see the changes far faster at your level than any of the national data will say. And just be ready, because the opportunities will always come during those time periods. So that's the extent of what I have. Let me jump into the questions. I know we've got a whole bunch of the questions. Guarantee we're not going to be able to get through them all, but I will be happy to answer the questions, because Moss Adams will send me these questions afterwards, and we'll try and tackle that. One question says, will tariffs ultimately assist in increasing GDP? I would actually argue tariffs will ultimately slow GDP, because, as I've said, tariffs are a tax on businesses, and that means that it makes that business less profitable than it would have been otherwise. Doesn't necessarily mean that a U.S. business is going to, base business is going to be that much easier. And what we've seen for a pattern, especially over the last 15 years or so, if your competition is raising prices, unless you're trying to go after market share, you may say, well, I can raise my prices too, because they're not going to go to my competition. So I don't think there's any clear answer to say absolutely, this increased revenue that I've heard people say we're going to have increased revenue, which will help GDP. That increased revenue goes to the government and it comes out of private businesses. So that's a wash on a net basis. Let's see, is it historically normal to see private industries tighten on spending during an election year, or is this more a result of current interest rate cycle? I don't have a clear answer for you there. I think during an election cycle, a lot of times what will happen is the economy almost pauses because everyone gets caught up in all the noise of the politics. So I don't know that it's an intentional tightening of spending, other than more of a distraction of worrying about what of these policies go into place. But I can't say that I can tell you definitively that yes, businesses always tighten in a recession. I mean, in an election, I would say it's more of a function of the rate cycle, and that businesses will start tightening on their spending when their profitability is changing, their sales are changing, and that isn't necessarily, well, there's no direct connection to the elections for that. I think I've covered the one about the increase in tariffs to the economy. What might it signal? That while the Fed cuts the federal funds rate, they also continue quantitative tightening. I think what that's signaling from the Fed is that they view that as two separate things. Interest rates, is a definite impact right away. You cut the interest rate, the prime lending rate goes down, things like that, and that can make projects more viable, help businesses. The liquidity side isn't as direct because from that standpoint, it's the case again that what we had before was excess liquidity from all of the money the Fed created. That was actually creating some misallocation of capital, that it was just chasing where the highest returns were. So I think they can operate those two completely differently, as long as they are, what they're monitoring is make sure there is sufficient liquidity, which they still think there is. To what extent are current market expectations regarding the growing debt and deficit already priced into the 10-year Treasury? What specific catalyst could trigger a more pronounced reaction in 25? My view is that the capital markets continue to believe the debt's not an issue at this point because we're still the reserve currency, all of that type of mindset. So I think that right now they haven't priced in the growing debt because it's not been a funding issue for the Treasury. I think the point in the time when we start to lose foreign investors for whatever reason, that's when the capital markets would have a fairly major adjustment of saying, whoa, okay, if we have to buy this stuff, we're not going to take it at these levels. We need a higher yield. And that's what we saw during the 80s when we had the deficit rising and the interest expense consuming more tax revenue. We saw the bond market become what they call bond vigilantes, that they would raise interest rates if the Treasury or Congress is talking about more debt, and that actually instilled some fiscal discipline. And I think this time around, that's not in play yet, but it's still a risk out there. The other threat for the 10-year would be if inflation doesn't come down the way people think, then there could be an additional inflation premium being priced back into the long end of the market. But what I think for right now is that the long end of the market is priced just about where it should be, because when you look at historically, and there is a very tight correlation to this, that the 10-year Treasury yield matches pretty closely nominal GDP, which means GDP before inflation. So we've got real GDP growing at 3%, which means you have that 2.7% inflation, and then the nominal side. So if we're just doing nominal, if we say, well, let's assume the economy is going to grow at 2% on a more consistent basis, and let's assume we're going to have inflation at 2%, the Fed reaches this goal, that would say 4%, which is where 10-year Treasury yields to be, and that is where 10-year Treasuries currently are. If GDP growth is faster or inflation is faster, that would actually imply that 10-year yields may have to rise some to compensate people for the risk of the economy growing too fast and reheating up, things like that. What might it signal? Oh, we already answered that question. Excuse me, I'm just trying to read through these as we go along here. Bear with me, there's just a lot. I'm just trying to pick a sample. Do I anticipate a recession? So my little bit of a snarky answer is absolutely. But the question is when, because every business cycle ends in a recession. I do not, I think as I talked about, I do not think that we are looking at a recession for next year, primarily because of what we see that consumers still has income available. I think the other thing that I keep looking at is we have not dispersed all of the stimulus funds. Everyone thinks that was used up in 2021. We still have money being pumped into the economy from the CHIPS Act, from the Infrastructure Act, as well as the Inflation Reduction Act. And that if that creates new activity, then that's going to help the economy as well. So I think that we're going to clearly see slowing, and it really comes down to where the biggest risk is, which may be hard to measure, is when the consumer reaches their breaking point and says, okay, I can't borrow anymore. I've maxed out my credit cards. I don't qualify for anything else. Now I have to cut spending because I have no choice. I'm not the US government. I can't print money. And I think that's one of the things that the Fed may also worry about. Is I've been using a term for those of us with the gray hair and who can remember the old Roadrunner and Coyote cartoon, where when the Roadrunner would make a sharp turn and the Coyote couldn't make that turn and went off the cliff, he was fine for a couple seconds and then boom, he fell rapidly. This could be a recession different than most, where you'd say the recession starts because businesses start to lay off people, their income's impacted, they have to cut spending, and then we roll to a recession. I could see the potential that this recession could be consumers still have their jobs, but they hit the wall on debt. They're forced to cut back spending because they don't have any other means to continue that pace of spending. And that actually then pushes the drop in purchases and then starts the traditional cycle of layoffs and everything else. So that's my outlook for a recession right now. What is the impact of tech companies requiring workers to return to office? That's a question still not answered, because I think we're going to have to wait and see. The position, I think if you could, survey most of corporate America, they would still believe that there's a benefit for being in the office because of the instant collaborations, the instant meetings that can happen just sitting, next to your fellow workers. Others argue that, there's lost productivity because of that. So I think it's the real question mark right now, because most businesses are going to sit back and see what the response is for those tech companies. Do they accomplish that? Do they see that? And where do we go from there? I would reflect just from a general standpoint. There was an article in the Puget Sound Business Journal saying that the number of remote workers in the Puget Sound has fallen dramatically. I think that's because of their heavy tech concentration there. But I would, to me, be more interested whenever the next recession hits, is that when businesses finally say, okay, now we have the upper hand again. Because there have been multiple surveys that I have seen that ask the business community what their strategy is for employment when a recession hits. And pretty, almost, I'm not going to say universally, but a pretty strong response is that remote workers go first, because then they have the core workers who are in the office collaborating with each other. So this is still a big unknown question. And I think everyone is sitting back waiting to see what the answer is going to be. Let me take one more question here. The rest we'll have to tackle as we go along, because I want to respect your time overall. What have the, I answered that one. Sorry, let's see. Do I believe the jobs report? Can the government manipulate the numbers to make it look like the economy is better than what it is? I'm going to tell you, I absolutely believe that the jobs report is as accurate as what's being reported. If you ever have met people in the Bureau of Labor Statistics, they are nothing but numbers nerds. And I don't believe there is any manipulation going on. But where I have trouble and have lack of confidence in the results of the job report is not manipulation. What the problem is the jobs report, like so many different government data sources, is they survey businesses. For the jobs, the Bureau of Labor Statistics surveys over 60,000 businesses, asking whether they added a job, eliminated a job, or unchanged. And then they compile that, and then they, from a statistical standpoint, say that's a big enough sample pool. This is what it means for the country as a whole. The problem is, before the pandemic crisis, we saw a response rate on those surveys in the 75 to 80% range. Since the pandemic crisis, we have seen response rates below 50%. So I don't think that there's any manipulation going on, but I do think that the problem is the reliability of the data, the pool of respondents, because my worry is the possibility that if a business is struggling to stay open and they're laying off people, that they may not respond to that jobs report. They just say, I don't have time for it. The other problem is just with technology, people don't answer your phone anymore. If you don't recognize a number, you're not going to pick up that phone. So they're not calling the same 60,000 businesses every month. It's cycled through. So the business may see a number and say, I'm not answering that. Or you get an email and it gets routed to spam. So I worry more about the response of the numbers. And that's why we see these downward revisions, because then they continue to follow up, continue tracking, trying to get an answer. And that's where they ultimately come through and tell us, what the revisions were. But I am very comfortable and confident that there is no manipulation going on. Well, we are at 11 o'clock. I am going to turn it back over. I appreciate everybody joining me today. As I said, I will answer the rest of these questions when they're sent to me. So I'll try my best to answer all that have been submitted. But I appreciate the opportunity and the time, and hope you found the information useful for your business. Thank you very much.
Awesome. Thank you, Steve, for such an insightful economic update. To our audience, thank you for joining our first session of the 2024 Virtual Building Opportunity Conference. As a quick reminder, due to the proprietary nature of these slides, we will not be sharing them. However, right after the webcast, we will be sending a recording of today's presentation. Our next session is on October 9th, which is How Technology is Transforming the Built World. And if you met all CPE requirements, your certificate is now available to download in the CPE progress window. A copy will be emailed to you within 2 weeks, should you have any difficulty downloading it now. And as a quick final note, we have a link to an online survey for today's presentation. Your feedback is always appreciated. And thank you, and take care, everyone. Take care. Bye.